What is a bad bank? Banks grant loans. This is part of our core business. Loans, however, carry some risk because it can always happen that a debtor fails to repay the loan on time or is unable to repay the full amount. If the number of defaults on loans rises steeply, for example, as a consequence of an economic recession or a burst of a real estate bubble, the existence of particular banks may be at risk. In such cases, it can be useful to set up a bad bank. But what is a bad bank? A bad bank is a financial institution founded for a single purpose: to gradually wind down or sell all bad loans and high-risk securities. To this end, the risky assets of one bank or several banks are outsourced to a so-called bad bank. By outsourcing, the bad bank takes burdens off the balance sheet of the remaining good bank and improves its credit rating. The bad bank takes over non-performing loans and so-called toxic securities. The task of the bad bank is to gradually wind down non-performing loans. It realizes the collateral and calls guarantees or sells loans and toxic securities at a discount to financial investors. This process usually takes several years. How high the losses are is only known at the end of this process. But the winding down over a longer period of time increases the chances of obtaining a better price. Because if the selling process for outstanding loans and risky securities is under time pressure, this always means lower prices. The objective of the bad bank is to achieve a better deal without time pressure. In order to make all of this happen, either a banking group or the state must back the bad bank by a guarantee. This is necessary because in the end, the bad bank is very likely to end up sitting on at least some unrecoverable loans, unrealizable collateral, and unsellable securities. Despite its name, bad banks are actually not banks. For this reason, they do not need to meet any strict capital requirements. They are one-off companies established for a predefined purpose with an expiry date, even if this date cannot be given at the time the institution is set up. Once a bad bank has liquidated or sold off its assets, it's usually liquidated itself. Bad banks make it possible to rebuild the trust in the healthy portion of a commercial bank and secure its survival. This concept has been implemented successfully many times in Germany, Sweden, and in the United States. Austria is now also gaining its first experience with bad banks.